So the way we look at risk, the way we look at investing changes based on the label we change on the money. There are 2-3 important biases that come into your decision making when you're using certain mental accounts and how you label the money. So the first effect is the house money effect. You would have seen gamblers when they go into a casino, suppose they have taken 10,000 rupees with them. And when they win certain money, say 10,000 rupees, they win as profits. They handle the two amounts, though they are same, very differently. So first 10,000 that they brought from the home will be very differently bet. And the profit that they got, which is what they call as the house money, they won it from the casino house. They treat it quite differently, possibly taking more risk on this profit of 10,000 than what they would do on the initial 10,000. Now think about new investors that come into the market, they are trading, and in a bull market, they are making money. Now that profit that they make, which came in very easily, they take more risk with that money because of the house money effect. The second type of impact that comes is when you make a loss, which is called a long shot fallacy. Daniel Kahneman, one of the psychologists who won a Nobel Prize in economics, he says, they did a survey, he says that in horse racing, they found that at the end of the day, the bets on horses that were least likely to win went up. So what we call as a long shot of winning. And they were trying to understand why it happened. They found that people who actually had made losses that day, towards the end, try to bet on a horse which is least likely to win, because if by luck or by chance if they win, the payoff is huge. And they will return home with some profit or at least much less loss than they have. So they are trying to close their day's mental account of loss with a profit, and that's why they are taking bets that generally they would not take. Same thing happens with investors. If you have missed a rally or a bull market, investors try to take certain securities which they otherwise would not take. Their investment process would not permit them to, but to catch up on that. And third, I think to some extent, there is also a sunk cost fallacy where people are more anchored to, say, their cost that they have paid and they don't want to take a loss. So sunk cost fallacy says, suppose you have tickets to a concert and that suppose it's an indoor concert and it's a few kilometers from your place, you have to drive down there. The tickets have been given to you free by a friend. And the weather department says that there's going to be a storm, it's going to rain quite heavily, and it's going to rain all night. And your GPS shows that there's huge amount of traffic towards that concert. Will you go or will you not for that concert? Now, the second scenario is within the same, that suppose you had paid 10,000 rupees for that ticket. And in the same situation, that's an indoor concert, but there's huge storm, rains, traffic is huge. Will you go or not go? Most people decide that if we have paid for it, I should go. The cost of the ticket is actually a sunk cost. Why trouble yourself so much to get to a concert? Maybe you get on time or no. But people go through that suffering because of the sunk cost fallacy. And the same thing happens in investments. People who have lost money on something try to close that particular security account with a profit. So either they wait for a break even, they try averaging that bad company or bad stock at a lower level, which is actually throwing good money after bad. So they don't take it as a sunk cost, that it's gone, I need to just move on. So these are the few things that impact your decisions based on mental accounts.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.